There's a saying in trading and investing that all too often gets swept under the rug: sentiment follows price. Just last week, market sentiment was all about the great rotation. Now the sentiment across market participants is eyeing lower levels in the S&P 500 as technology stocks lead the downside. But sentiment is often a lagging indicator and often leaves you on the wrong side of the trade. So today we're going to look at the latest charts and leading indicators to make a determination as to what comes next for stocks as the S&P 500 enters negative gamma. We all know that negative gamma often leads to lower levels, and we need to talk about key levels of support for the S&P 500 on the way down. We're also going to talk about earnings, fund manager positioning, and of course, rate cuts. What it means for markets and what it means for the real economy. Will rate cuts have the effect they're intended to? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. So if you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and when you look at this, not much to take away. You can see some very clear trends here in technology. Semiconductors, very red on the day. This just stemmed from the flows we are seeing in the tech sector. It's down heavy for the week, but also some of the news we got in CrowdStrike. They had some issues with regards to Microsoft. CrowdStrike was down 11% on the day. Microsoft was down 0.74%. Other cybersecurity competitors of CrowdStrike did gain, however, but it was a mixed day across the board. Apple, Google, Meta were pretty much flat for the day. But when you have some of the bigger names virtually flat and then some concentrated selling in stuff like Microsoft, Nvidia, and even some of these financial names, excluding banks did very well. We'll talk about why. You're actually going to get a day where most of the market is red, the S&P 500 is red, and the S&P 500 did fall 0.71% year to date, with a lot of the selling concentrated in technology as well as energy. Tech was down 1.6%, energy down 1.1%, and financials down 1% as well. And when you have financials, energy, tech falling, you're going to see the S&P 500 have a red day. And there were some very clear things we're seeing in the market. Yesterday, we were talking about a potential liquidation that could be happening in the market, and I think a lot of that selling that we saw yesterday spilled over into today's trade. And then the market also did get a bit defensive. Look at the only green sectors here: healthcare, utilities, very defensive sectors. And then we actually have a look at the next best performing sectors: real estate and staples. Yes, they were red on the day, but they did outperform the S&P 500 and the broader market. And staples is a defensive sector, and real estate has a lot of defensive qualities and is also heavily tied to the rate cutting theme. Other than that, comm services, industrials, discretionary materials were all red on the day. That's going to weigh on the S&P 500. However, large caps were the worst performing factor here today. Large value core growth down 0.6, 0.7, 0.7%. You actually have a look at small caps, and this is why you can tell there's actual strength happening in the smaller size space, because they were down less than what the large cap components were. Small caps down 0.6, 0.5, 0.5% respectively, and then mid caps as well. So you don't just judge strength to the upside, you also judge strength to the downside, and we are seeing outperformance in smalls throughout this week, even as the selling continues. If smalls outperform to the downside, that is just as good as outperformance to the upside when it comes to determining overall market strength. Along with the spillover from yesterday's liquidation that we saw in the market today, we also saw some very clear and discernible trends which didn't help overall price action. Yields actually did rise, and the dollar did firm up 0.18%. Second, you have yields rise and the dollar rise. That is going to impact stocks. Gold down 1.83%. The same is true for silver, back to the $28 level. I think we're just probably going to be building out a base, looking for the next move to the upside or downside. I am bullish on silver for those wondering. Looking at crude, big move to the downside right now, down 3.27% here on the day. Vicious move, but still above our 77 target range right here. But this is such a volatile asset class. In light of everything, small caps were down 0.51%. The equal weight was down 0.67% today. Mid caps down 0.71%. The Nasdaq 100 was the weakest of the bunch, down nearly a full percentage point. And then the S&P 500 down 0.71%. We're going to look at the S&P 500 here today. In the weekend video, we're going to tackle the IWM. So subscribe so you don't miss the full analysis of small caps and where I think they're going to go next week, which is probably the more important thing to look at right now as these larger names come under pressure. We're going to start on the weekly chart, and you can see some very clear and discernible trends. Number one, we are in an uptrend. You can see here's a low, higher low, new all-time high, closing high last week, wick high this week in the context of making higher highs. So we are in an uptrend. Nobody can say anything different, despite the candle we saw this week, which was pretty red, not quite a bearish engulfing candle. You'd have to engulf that wick right there, but a very vicious candle and a very ominous candle nonetheless in the context of what has been a remarkable rally off the 2022 lows. There's a few things I want to note first. The first is actually the current JEX map of the S&P 500. Yesterday, we were looking at the S&P 500 and we said two things. Number one, the call resistance moved up to 57.50. That's often a bullish sign, and it's still at the 57.50 area. And we are in negative gamma because we're below the gamma flip zone. I also said yesterday that 5,500 was going to be a very, very clear cut zone. And if we broke below 5,500, it would take us to the 5,300 area. It looks like the market actually paused right on the 5,500 area. We closed the week there, and this is going to be a very, very strong line next week. I still remain convicted. 5,500, if we break it, we're probably going to the 5,300 area. But something to note, the put support was at 5,300 yesterday. So we were here in the put support yesterday. The put support actually moved up to 5,500 area after this OPEX. So this is very, very interesting. So this allows us to do two things. With the put support now at 5,500 area, if we just find support and then continue higher, right, we go to 57.50. If you break below the put support, things get really, really viciously ugly, because then dealers really start hedging their portfolio, and they hedge in line with the trend, and the trend will be down. And the second dealers start hedging with the trend, you get huge capitulation moves, and that's what we potentially could see. So bulls need to find support at this level and move us higher. If not, and we do break below, I think we're going to see downside over the next couple of weeks to the 5,300 area. So the 5,500 area on the weekly chart is absolutely mission critical, and so too is the 5,300 area. Now let's dive into the daily chart just to see where we stand. Looking year to date, the S&P 500 has had a remarkable rally. On a percentage return basis, we're still up about 15% for the year. It's been a great run. No one can tell you otherwise. Equities are bullish right now, and the same zones that apply to the weekly chart apply to the daily chart, and that's how we know we are in a critical time period right here. When the weekly support and resistance lines align with the daily support and resistance lines, things are going to get dicey. So this week, you really want to pay attention to this zone right here, the 5,500. You can even go as low as 5,450. You want to find support. If we don't find support for the bulls right here, we are definitely going to move lower. I think a great hedge for the S&P 500 will be small caps, and we're going to tackle them in the weekend video. But this is where we stand for the S&P 500 right now. It's either the bulls find support right here and go, or we see more downside to the 5,300 area, which would be a peak to trough drawdown of 6.5%. Very, very similar to the same amount of drawdown we actually saw here in early April into early May, 5.83%. On average, the S&P 500 has about 5% pullbacks every single year. So to even pull back to 5,300 wouldn't be too crazy, and it actually could happen over the next week and a half. The July window of weakness is actually a fairly long one. It's actually 9 trading days compared to the usual 6. So it's about 50% longer than the average window of weakness. And that's why we could definitely see downside. But like I said, guys, everything is contingent on this 5,500 area. If we open Monday, find support, tech stocks catch a bid, we go higher, 57.50 is our target. But if we do break below here and we have quite a lot of price discovery below, maybe we don't get the data we want, we're going to use this line as resistance, and then we could actually see some pretty vicious sell side here in the 5,300 area. But it would actually be completely healthy, especially as earnings come in. If the market pulls back, earnings come in better than expected, stocks get cheaper on a price basis and an earnings basis, and that's your signal to get long. I do think long term, you look at this chart, this is bullish. You can't fault this. This is a bullish chart, and you want to be long S&P 500 equities, and we are starting to see that broadening out in small caps as well. Yes, we did see quite a lot of volatility from the midweek here in small caps, but after a 10% rally, to see a 2% pullback, completely normal, and we're going to tackle small caps in tomorrow's video. So let's talk earnings. We've had a very mixed week of earnings, mixed across the board, and we had some some big names report as well. United Health did well, ASML not so good. It wasn't just earnings, there was a lot of stuff behind the scenes affecting overall price action. But today we're going to dive into American Express, see how they did. Now, very mixed earnings here from Amex. They beat on EPS 349 versus 326 on sales of 13.33 billion, which they actually missed, however. But you dive into the details, and the reason they missed this had to do with foreign exchange hedging impacts. If those impacts weren't present, they actually would have beaten their sales figures. She did see the management raise guidance. They said, we are raising our guidance for EPS for the year to 1330 to 1380 within that range. They also said, we are confident in the ability of our business to support the year-over-year growth of around 800 million in marketing while delivering mid-teens EPS growth. So they're raising marketing, expecting EPS growth to be in the mid-teens. They beat and raised, maybe not so much on the sales figures, but technically a beat under the hood. I think adjusted, they would have had a sales beat. And that's why we actually did see quite the upbeat action here in American Express from the lows. Yes, the stock was down 2.74%, but if you actually have a look at banks overall, JP Morgan, Wells Fargo, Citi, they did really, really well. And I think we're actually going to see American Express rally into these earnings over the next couple of weeks. I thought these were good earnings. I actually thought these were good earnings despite sales. And the CEO came out and said a bunch of stuff about the consumer. And he said things are looking good for the consumer now. American Express does have a more affluent customer base, so you can take that with a grain of salt. But all in all, I didn't think they were amazing earnings, but I thought they were good nonetheless, and this should support price action into the next quarterly. Now, just some incredibly interesting data right here. This is essentially what happens when the Fed is done hiking. Now, the Fed was actually done hiking around this time in 2023, and we're yet to see what the 12-month returns is. But in a couple of days, this will print, and it's looking like it's probably going to print around 25 to 27% return in the last 12 months, blitzing the average and median 12-month return. This just goes to show that oftentimes when the hiking cycle is done, that is your signal to go long. At the same time, when the Fed hikes rates and then goes on a cutting cycle, when there's a technological revolution like there was here in the early 90s, this is 95, 96, 97, with the internet, as we are having with AI right now, that often leads to massive outsized returns. Cheaper debt allows for further technological innovation. It allows innovators to get in, exit on a much cheaper basis, make money, and then fuel money for the next technological cycle. And like in 1995, I do think AI is completely revolutionary. We should see something similar to this when the Fed cuts. And if you think the S&P 500 is crazy, things can get more wild with the S&P 500 making higher highs. But just how important is confirmed new highs? According to the Lithol Group, it's insanely important. And what the 1929 and 1987 crash lacked was confirmed new highs. The current rally we're seeing in 2024 is not like these years right here. The S&P 500 and the New York Stock Exchange advanced decline line made new 52-week highs in July. The advanced decline line is confirming the highs we made right here, and this often points to further outsized returns from August to December, with only one negative return in 1943. At the same time as we are getting these new highs, it's simply because profit margins, earnings, are set to increase by a wide margin. The profit recovery for small caps, while it might not be happening this quarter right here, it is expected to extend throughout 2024 and 2025. Despite the revisions in earnings we've seen in small caps in recent weeks, earnings are expected to still be stellar, 6%, 21% here in small caps, and even higher in 2025. You could see, yes, we've had massive revisions, but the market is pricing in future growth, and we can actually see that the equal weight S&P 500 growth and value have actually held up a lot better than you would think, with the S&P 500 actually seeing mild up revisions since this point right here around the midway point of 2023. Growth has been the winner. The S&P 500 has been a beneficiary. Value, the equal weight, and the RSP has seen mild down revisions, but not necessarily a bad thing, because stock markets on average see 8 to 12% down revisions from their initial analyst expectations. It's completely normal to see revisions to the downside, and this right here is completely normal, in fact above trend, whereas this right here is what normal revisions usually look like, and that's why we're seeing outsized returns in S&P 500 small caps. Now, looking at equity fund flows, despite the price action we've seen this week, we've actually seen inflows in equities of $39 billion pretty much from the 17th of July. If you look 5 trading days back, this is the time period. Both are right here references with regards to the inflows. So a lot of the inflows we have seen in this past week came towards the end of last week, the start of this week. Maybe not so much the recent couple of days worth of price action. Nonetheless, we have seen $39 billion worth of inflows. We've actually seen inflows here in the last 5 weeks, and the 12-week moving average actually moving in the direction you want to see upward, actually making a new high since August 2023, meaning people are bullish on equities, and that right now is the sentiment, with short interest as a percentage of market cap at 1.9%. Now, this may look quite alarming that this chart is going up, but the truth is, when you compare this to the historical average, we are at record low levels of short interest in the S&P 500. At the same time, FMS Investors cash level rises to 4.1 from 4%, and the only time we've ever been in this region right here has been in very key points when the market has been very, very bullish. Pre the GFC, 2011, after the GFC, 2013 when we broke out to new all-time highs from the GFC lows, 2003 after the tech bubble crash. These were periods where you wanted to be long equities. Even in 2007, there was a good 18 months of like 100% gain in the S&P 500 before we actually had that massive crash. And FMS investors know the environment we're in, and even though the cash level did increase, we are still well below the 5% level and at record low levels yet 4.1%. And you want to be long in this market. And if you do get above the 5%, that's when you can really start to maybe pull back. But as it is right now, you want to be long, you want to stay long. We also know that FMS investors are highly exposed to US equities. This is the NAM exposure index sitting at 87.94%. And pretty much this tells us that US fund managers are 87% exposed to US stocks. It's a very high level. It has actually come down in recent weeks from its highs. We were sitting at about the 103% level. In other words, fund managers were levered long to US equities, but 84.9% is still a very high number. And we've sort of been trending in this range right here between 80 and 100% for the better part of 2024. Now, a big part of the rally and overexposure we've seen in the markets recently has to do with the fact that rate cuts are coming, earnings are improving. And here's a quick note we got from BofA with regards to the cuts coming in September. They say, given the public remarks by Fed members, it seems clear that the committee has gained some confidence on inflation and is comfortable in communicating a rate cut cycle that begins this year. It also seems clear that the committee has moved closer to thinking that the first rate cut could happen in September. We agree and think a September cut has moved closer to the baseline, but given Governor Waller's remarks, we are not convinced that the majority of the committee is there on September just yet. And the reason why the Fed actually want to cut rates, or part of the reason why, has to do with real Fed funds. Real Fed funds is actually the current funds rate minus inflation, whatever target you want to use, 2.5, 2.6, 2.7, up to 3%. Essentially, what is the real cost of your debt? You can see it since 2022, as we have seen inflation come down in a big way, real Fed funds has actually spiked up above the zero line. And what the Fed want to do is cut rates to normalize policy. You could decrease real Fed funds in two ways. You can either increase inflation, or you could simply just decrease the Fed funds rate. The latter is far more predictable. This is part of the reason why the Fed wants to cut rates. And the truth is, guys, when the Fed does cut rates and growth in the economy is robust, equities do really, really well. This is the average return after the Fed cuts rates. So this is when the cutting cycle starts. This is the average if no recession. We normally see outsized returns in the S&P 500. 24 months later after the first cut, you could see 20 to 40% returns in the S&P 500. However, if growth is weak, if we enter a recession, in other words, 2 quarters of negative GDP growth, we actually see quite vicious sell side in the S&P 500. Now, Goldman do expect growth to remain robust for 2024, 2025. Now, this right here is a forecast. It's a little bit dated. Goldman have actually increased their GDP tracking from 1.8% where it was just a couple of weeks ago, right now to 2.6%. We actually covered that in yesterday's video. So go ahead and watch yesterday's video to get the latest Q2 tracking update from Goldman. However, Q3 for 2024 and 2025, these figures are unchanged, and they see 3% growth 2.5%, and then for the majority of 2025, they see 2%, and in the fourth quarter, 2.2% growth. In other words, they expect growth to remain robust, and when we have robust growth in a cutting cycle, stocks tend to do very, very well, despite the near-term volatility we are seeing in the markets, which is completely normal. From around middle of July towards the end, the 25th, so from about the 17th, 18th to about the 25th, 26th of July, we actually do see quite a bit of downside, but it's normally just a buy the dip opportunity because we normally do form a higher low and go ahead and break the highs into the end of July, returning upward of 1.3% in the S&P 500. Now, this is seasonality. It's not a crystal ball. It just helps us to assess probabilities. And essentially what we're seeing right now after a very strong rally in July is actually just a bit of a pullback, seasonally to be expected. Now, what is to be expected of small caps? This right here is BofA's technical charts of the IWM. They say a bullish breakout for the Russell 2000 above 208 to 212 confirms a bottom for the small cap ETF from the 2022 to 2023 lows, signals upside targets potentially to 230s and 240s and even towards the 260s. This breakout also confirms a much healthier summer rally, broad participation. Prior resistance at 212.28 reverses its role and now offers support. So this area right here is resistance turn support. The 40-week moving average has the potential for a golden cross above the 200 weekly moving average. Important chart support remains at 191 to 187. So this right here is support if we are to pull back. Key and critical support that we need to hold if we do pull back. However, both I think we're actually going to find support here at the 212 to 208 range and then continue the move higher. We're seeing broad participation, earnings improvement in small caps, and that should lead to the move higher. Upside targets of 234, 244, 260. And ultimately, my long-term target at the end of 2025, early 2026 is a 300 IWM. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.